All right. Well, good morning or afternoon, if that is the case for you. Thanks for being here, everyone. I'm Simon Meow, and I'm with Rocky Mountain Insurance Network. We're a brokerage general agency, life, annuity, long-term care, disability insurance. Today, we're going to talk executive bonus, Section 162 bonus plans. Instead of using life insurance, we're going to talk about using asset-based long-term care. And we have an awesome guest with us today. Our friend Richard Crispin from Securian Financial is going to be chatting with us here in a bit. I'm going to chat for 4 minutes, maybe 5, about Section 162 bonus plans and using asset-based long-term care for it. And then I'll turn it over to Richard, and he can get after it. So with that said, let me see if I can't get my little cheat sheet slide deck up here and running real quick. And God, sorry guys, this is terrible. We're almost there, I promise. All right, I think I did it. that was the worst one I've done. So Section 162 bonus plans. Geez, sorry, here we go. We're going to talk about sort of a fresh way to look at these. So usually we're talking about using it for life insurance, but the twist today is we're going to talk about using it for long-term care coverage. So am I sharing the right screen, Richard? I'm having a really hard time here. Does it say why fresh approach is needed?
Yes.
Thank you. All right. So your traditional executive plan is focused on the life, right? That's not always addressing the real risks, though, that executives are facing. When we're talking about like where are the gaps there, we're talking about rising costs of care. Maybe they've had some personal experience with loved ones needing long-term care. And there's been some state legislation mandating long-term coverage. We saw that in Washington a few years ago, and there was some others that may follow suit. But really, in today's environment, long-term care coverage may be more valuable to executives than life insurance is. And maybe not just for themselves, but their families as well. And so that's where these Section 162 bonus plan may deliver an effective way to deliver that benefit. So we're going to look at sort of the mechanics of how this works. So the employer is going to provide a bonus through and pay that policy premium. So the bonus, the employee owns the policy. He's going to have to pay income tax on that bonus. And there's an opportunity here for the employer to give a double bonus, maybe to cover the taxes, sort of gross up the bonus in order to cover that. But we can design these as such that maybe we can spread that bonus over a period of time, sort of a longevity incentive here, 5-10-year period, call it the golden handcuff thing. And the end result here is that the employee is going to own a fully funded long-term care policy. So here's kind of how it looks. The employer is going to give an annual bonus to the key employee. They are going to pay that premium to the insurance company, but that is a deductible expense to the employer because it's a bonus. The employee is going to have to pay the tax, the income tax on that. But again, the end result here is what we'll go to the next page, the benefit at the claim of death, the benefit at claim or at death, rather. So if the employee needs the care, the benefits are going to flow directly to them, right? Tax-free. We know that. If they never need care, though, and this is kind of cool with the asset-based long-term care, there's still going to be a residual death benefit for their beneficiaries. So either way, the executive and their family are going to get some of this like pretty meaningful protection. And the company is going to strengthen its both retention and longevity and loyalty, rather, of that employee. And so one other thing here to emphasize is that the benefits here, they're personally owned and they're portable. So unlike some of other employer benefits, group term life insurance, for instance, that's not portable, right? Once you leave the company, the coverage goes away. This is fully portable. It goes with the employee. So this is kind of how it looks once there's a long-term care claim or death. So we've gone through the employment phase, the bonus phase. Now we're talking about during employment, maybe, or at retirement, there's a long-term care need. The insurance company is going to pay that long-term care benefit to that key employee. And if there's still surrender value left in that policy, either they never needed that long-term care coverage, or maybe they only needed a bit of it, there's that death benefit at the end that will pay income tax free to the beneficiary. So then just a quick recap, then I'm going to hand it over. Talking about, employers are getting a deduction here for the bonus. The employees are receiving a tax-free long-term care benefit and a tax-free death benefit. I should say and or. So just a quick example here, like for a 55-year-old male, you put in $10,000 a year, we could receive somewhere around $6,000 a month of long-term care benefit. And with a double bonus structure, the employee's net cost here could get reduced to zero. So, in a competitive job market, maybe this is that golden handcuff scenario that employers are looking for to keep those key employees, those executives on for another 5-10 years, whatever the case may be. So that's it for me. I did it in like 6 minutes. I lied. So now I'm going to hand over to Richard. Richard, thank you so much for being here with us today. I'm going to stop sharing and let you have at it. There we go. All you, sir.
Perfect. Thank you. Let me just bring up my slides here. Can you see my screen, Simon? Oops. Let me get back to. There we go. Can you see the screen?
I see your presentation screen. You probably want to swap.
Perfect. What's that?
You probably want to swap them. If you go to your display settings and swap.
Oh, I see. Okay. Let me.
There you go.
All right. Perfect.
Boom.
So let me just first off, just kind of highlight a few things. I'm going to expand a little bit more on what Simon said, but I work for Securian. I'm one of the RVPs. I cover the South Central region. I have counterparts across 5 other counterparts across the U.S. We're part of Minnesota Life, also known as Securian. I am going to expand a little bit, not just on the concept, but also talking about the different types of company structures. So think of it this way. As advisors, you all are small business owners. So the concept that we're going to talk about today is how can small business owners utilize this as part of their plan and get to double dip, not just for their key employees, but also just for themselves. So let me talk about it a little bit from the concept of executive carve-outs. First off, who is Securian Minnesota Life? We're actually the 4th largest provider of linked benefit sales nationally. We've been around over 145 years. We are 95, that's the top 5 percentile in the Comdex ranking nationally. So very secure, very old conservative organization. But why does this conversation matter to you and your clients? First and foremost, if you've heard the term silver tsunami, a lot of people kind of see it coming with the baby boomers, demographic change nationally. A lot of folks are aging into older ages. And we're still in the silver tsunami for several more years, where you're seeing just massive amounts of individuals turn 65, becoming, as I'll call, seasoned citizens or senior citizens. And at some point, I look at, when I have these conversations, just to give you a little background, I am a certified financial planner. I was in private practice doing that prior to getting recruited and coming over to Securian. So I had these conversations directly with business owners, directly with when we look at their holistic financial plan. But the way I would talk about it was really, look, all we're having a discussion is about retirement planning. And there's different parts of retirement planning. As we go through our retirement journey, everybody's going to be a little bit different. But we have stages where maybe I want to travel a lot. I want to do all these really great things I couldn't do when I was working. And then maybe I start to age a little bit more and I want to just have time with my grandkids and enjoy life and do things like that. But we're going to hit a certain stage of our retirement journey where we start to need a little bit of help and we start to need care. And that's really the discussion we're having. I don't phrase it as long-term care planning. I really discuss it more as just part of my retirement planning and the part where I start to need a little bit of help. And that's just, the way life is. Whether you've experienced it with grandparent, parent, you've seen it maybe with other family members or friends, or even potentially for someone more yourself or other directly in your family. But here's the thing. Folks are going to need that, and we see these costs. I kind of look at it as supply demand. We got this massive demographic age change coming with a certain supply of people who provide care, which means demand's going to go up. We have more of a fixed supply. That means costs are likely to continue to increase. When I was using financial planning software, acute care, which is your hospital care, I broke my leg, I did all this stuff, I had some surgery. That's acute care. The software projection was looking at and using an inflation rate of 5.1%. For long-term care services, the inflation rate was about 4.5%. I know some of those costs have gone up faster than that. And also, I will say some of those costs in different regions have gone up faster, particularly the two coasts. You see massive increases in cost. But the point to mention here is we look at our healthcare and retirement, most people that's Medicare really is not built to cover that kind of care. If you look at Medicare.gov, it explicitly states it does not cover long-term care services. It's not meant to cover that. It will help after a 3-day hospital stay. It'll help put someone saying, or what's depending on where you're at, a nursing home, or sometimes they're called rehabilitation facilities or something like that, skilled nursing. And it will cover the first 20 at 100% and then part of the next 80. But again, it's not meant to do that. It has a very, very finite and limited benefit providing those types of services. So, when I would talk with clients, I would say, really here are the 4 key questions you need to think about. Where do I want to receive care? By far, most people want it to age in place. I want to live in my house. I want to age here. I'm comfortable. These are my surroundings. This is my house. I built it. I spent my entire life paying for this, have my family grow up here. Great. Who do you want to provide that care for you? And what's that look like? Are there any specific wishes or how you want to receive your care? And most importantly, how do you plan on paying for that? Because if you don't have a plan in place to pay for it it's not just paying for it, it's not just the money, but in a manner that's tax efficient, what's that going to look like? Believe it or not, home care in many cases is substantially more expensive than going to a facility, which is expensive in itself. But getting care at home, particularly when you need it for maybe many, many hours a day, it gets incredibly expensive. So I look at this and can share a little bit of a personal story here. This is my father. He had received care at home he started at age 80. So 7 3/4 years, he was getting care at home. That's a long period of time. And I will tell you, my mother's mother, my grandmother, received care. She died 2 months shy of 102. She received care at home her entire life. Incredibly expensive, unbelievable the amount of money that was paid out of pocket. But I can tell you firsthand, it's not just about the money, but you also got to think about I'll talk about the money in a sec, but think also about the experience for your family, whether it's your spouse and or your kids, emotionally, physically, and mentally. What experience do you want that to look like for your family? And so, when we think about paying for care, there's really 4 ways we pay for it. Most wealthy individuals, let's say small business owners, say, you know what, I got enough money. If I have to write this big check, I don't really want to, but we can write it, sell investments, and self-fund it. Okay, I'll talk about that in a sec. So I'm going to defer on that one, but that's usually what more affluent or high net worth individuals will do. Typically, small business owners fit into that category. Or maybe my family's going to provide care. My wife told me if I'm nice and I don't complain too much, she would provide care for me when I get older. Um, we'll see. But, again, if my kids are going to provide or my grandkids, do they know that? What's that experience going to look like? Or maybe some people say, hey, Medicare is going to cover it. Well, Medicare will cover a teeny portion of it. The government really, by far, is the largest payer of care. And guess what? It's through Medicaid, which is a social safety net program when you basically become poor because you spent all your assets, and then the government steps in to pay for care. So that's not necessarily the plan I'm looking for. And the last option is to say, hey, how do I transfer this risk? Do it in a manner that I'm going to get leverage, meaning taking $1 and turning it into multiple dollars day one and grow it with inflation. That is paid to me tax-free from an income tax standpoint, tax-free. But this is often overlooked. Also, an IRMA Medicare surcharge tax-free. So a lot of people don't realize when you turn 65, unless you're still working, your Medicare is your healthcare provider during retirement. And the amount you pay for healthcare is based off your modified adjusted gross income. Well, if I'm going to self-fund this and I'm going to sell investments to pay for my care, well, what did I do? At a minimum, if it's an investment, fingers crossed, I'm going to have a capital gain. That's more income tax, but it's also going to impact my Medicare surcharge. Worst case, I'm using qualified money, which is 100% taxable, which is greatly going to increase my income tax, but also I start getting into trouble with IRMA or my Medicare surcharge, meaning I'm paying more for healthcare for me and my spouse, by the way, and I get nothing additional for it. I don't get that thank you note from the federal government saying you pay so much more for Medicare, and we greatly appreciate it. You're our best client. We just wanted to say thank you. No, you get a bill and you get nothing else. That's it. Nothing additional for it. No thank you note, no great Christmas cards. It just doesn't happen like that. So the whole point is not necessarily for those who are affluent or higher net worth and they're small business owners, can they fund it? Do they have the assets to fund it? Is this the smartest way from an income tax and a Medicare surcharge tax? Is it the most tax efficient way? Or could I have transferred that risk as part of a financial plan and got tax-free money that allows my spouse and my family to oversee my care with this tax-free money and give a completely different experience? And I build it on a life insurance chassis. So if I never use it, there's a death benefit. I don't lose this money. It's just, again, part of a financial plan. So that's what we want to talk about. And I want to talk about today using it, and in this case, doing it and having it paid for a small business owner through their company. So I'll start with pass-through entities. So think of sub-S, LLCs that run as a sub-S, things like that, sole proprietors, or they're passing through that income. A couple things to point out. When they are funding something, let's just, Simon and I own a small business. Let's say we have 15 employees, 2 of which are executives. They're VPs of sales and VP of operations. So 4 of us are the 4 executives in the organization. Unlike, say, a 401k, which is subject to ERISA, the Employee Retirement Income Security Act of 1974, which if I did a profit sharing or defined benefit contribution for the 4 executives, I have to do something based off anti-discrimination testing for the other employees. When I do an executive carve-out in an asset-based long-term care strategy within a organization, I am allowed to create and provide and carve out just one specific class of employees, classification of employees within the overall organization. But I have to treat everybody equally. So if I say I'm going to do an executive carve out for the executives in this organization, Simon and I and the 2 VPs, VP of sales and VP of operations, those 4 individuals that we are carving out, and we are going to do an employer funded long-term care plan for them. Not necessarily for anybody else, but just for these 4 individuals. What does that look like? Well, it looks like this. The business is paying the premium to Securian. We are insuring the, in this case, owners, execs. We are passing through the income to the owners. But if you look at the second bullet point, it is deductible to the owners as an above the line deduction. And that's a big deal. And your accountant will understand this. If it doesn't make sense, I'll show you in the next slide. But what it means is, regardless of how myself or the executives file their tax, whether I itemize or whether I just take the standard deduction, the business still gets the deduction. It's above the line. I'll show you what that means. That's a big deal. That means that I get to double dip as a business owner. I get the deduction on the front end, always above the line. And when I get to use the benefit down the road, it's tax-free income and Medicare surcharge tax-free. So it's duly beneficial. And also, I'll say this, a lot of business owners are looking for additional deductions where they can just do things for that specific executive group, not necessarily for everybody else. This gives them a way to be able to increase their deductions. Maybe I want to spread it out and pay it over 10 years or 15 years. So I get to get a bigger chunk of that premium that's deductible to me every single year, deduct it, and then get it tax-free on the back end. So it looks like this. This is what it would look like for a sub S, LLCs that pass through, individuals. My income, I get the deduction right there. That's the adjusted gross income. And then I pick the standard or the itemized deduction to determine my taxable. So I always get the above the line. And that's a big deal, folks. I'm telling you right now, the cool thing is Simon is going to send you two PDFs after we wrap up. One is advisor use. One is consumer business owner that they can give to their CPAs. The nice thing is it has every single kind of company structure. So in this case, let's use sub S. And it has all the tax codes to show their accountant exactly where they're going to be able to show that deduction and how it would look. So we have them both in advisor and client approved worksheets to be able to show this, the actual codes that are listed out there within the guides that he's going to follow up on. And it will show for every single company structure what that looks like. Now, that was pass-throughs. Here's, again, could be sub S, could be partnership, could be sole proprietor. I'm taking it as income, but the life and long-term care, the long-term care portion, which is treated as self-employed health insurance, I'm able to deduct that up to my annual amount. So I looked up for a 61-year-old individual, that's $4,810 a year. So if I do a 15-year premium, maybe I fund a premium, 7,000, 8,000 a year. About 2/3 of that's the long-term care portion, roughly, depending on, some variation, but somewhere around there. I am going to take that and I'm going to be able to fully deduct that as a self-employed health insurance deduction. That's a pretty cool concept. And guess what? When they get paid out to them later on, it's tax-free income as well as IRMA tax-free. Let's look at C Corps. C Corps are actually even more simple. Business pays the premium. That long-term care portion is fully deductible. They can include spouses, dependent owners. The life portion and the waiver of premium portion would be includable as income, but the long-term care portion, that part is treated as health insurance. So again, fully deductible as to the organization as health insurance. So employees, business pays, same thing, going to treat it as the life insurance. Simon talked about it. You can still use a 165 on the life insurance on the waiver of premium portion, so they can bonus it up to make it tax neutral to the individual if they choose. But in this case, the long-term care portion is treated as health insurance. That's pretty cool. So let's talk about, what does it look like? Why would we use an asset-based long-term care strategy to make this work? Well, one, I want to know that I've got a long-term care benefit that's guaranteed. We guarantee our benefit, as well as if we put an inflation rider, say 3 compound on there, we know that that amount is guaranteed. I could show you on the schedule, and they say, what if I need a care at age 77? I can show them exactly what the guaranteed benefit's going to be. They know exactly what that will look like. But If I die in my lounge chair with a smile on my face after the University of Texas beats Oklahoma in football and never need this thing, there's a death benefit. We're not losing the premium. That would go directly to my beneficiary. We even build in return of premium options. 3 of them. One, if they wanted a full return of premium year 6, they could walk away with their cash. Great, that's up to them. Or what most people use is the one that maximizes long-term care benefit. And then we got one in the middle. So they can pick. Most people use the one to maximize long-term care because I'm really buying it to solve for that issue. And then let's say I had a 15-year policy as a business owner, something happens and I can't pay premiums. They don't lose this benefit. We just give them a reduced paid up benefit. There's no more premiums. They will just have a smaller benefit that they would keep in as an asset within their portfolio. So it's something they're never going to use. Here's an example. This is a 62-year-old married female. Just for simple math, I wanted to show you the leverage. Let's just say this person did a $100,000 single premium with a 3% compound inflation rider. Day one, if I look over here on the far right column, day one, that 100,000 is 404,000 for a long-term care benefit. So about a 4-to-1 leverage ratio. But with the 3 compound at age 85, I'm almost 8-to-1. So again, monies that I can use to provide care for me when I have hit that part of my retirement journey. And that's really all we're trying to do, is just to say, how do we do this? Not that you don't have the money. That's not really the conversation. The conversation is, how do we provide a benefit that's going to give us maximum leverage? We know we're never going to lose that premium if we don't use it and just pass. And also tax efficiency from an income as well as IRMA surcharge standpoint. So that, to bring us on time, Simon, I'm going to stop there and see if there's any questions or anything.
We have no questions yet. Does anybody have anything? If you can, shove them in either the chat or the Q&A down there. That was great. I mean, a lot of you on the call may be familiar with Section 162. We throw the numbers of IRS codes around a lot. You don't necessarily need to, well, you don't really need to know any of that, right? The idea is that when you're going to talk to a business owner, just know that you can present it as such that if you want to cover your key employees or yourselves with long-term care coverage, either for your benefit or for the benefit of the employee and their retention, just know that it can be an above the line deduction to the company. And whether the whole Section 162 never needs to actually be said, that's something really for the accountants afterwards. So I just wanted to make sure that everybody knew that. I did get one question. Is Securian competitive with 5% inflation protection? And when is it a good choice?
So 5% compound, we have both 5%, both 3 and 5% simple as well as compound. So all 4 options. 5% compound is very expensive just across the board. So are we competitive with everybody else? Yeah, I can tell you across the board as an industry, it's really not priced as advantageous as, say, 3 compound. I would absolutely suggest you can certainly look at both. The nice thing is on our illustrations, we show every option. So if you build an illustration with 3 compound and you want to see what it would look like with 5 compound and what the cost differential or vice versa, we build that into the illustrations itself so that we have a matrix as part of one of the pages. And I will also say this, our illustrations are incredibly simple and everything is guaranteed. So we don't require client signatures on our illustrations because everything is spread out and it's all guaranteed in the contract. But those numbers, 5 compound is expensive. I bought a policy maybe 15 years ago with 5 compound at a prior organization. Actually, Simon and I both worked at. Now I look at the pricing to do the same thing and it's astronomically different. So just because of the way the interest rates, were super low for a long period of time, and then obviously came up, the pricing of 5 compound is higher. That's why I would suggest looking at a 3 compound. And even if you wanted a bigger benefit, I would do it more on the benefit side, increasing the benefit with 3 compound versus just trying to grow it to a larger amount. I think it tends to work more efficiently from a cost standpoint that way. And the other thing, just to piggyback on Simon's comments. Guys, you don't need to be experts on this stuff. All you need to do is call Simon up, and if he needs, he can engage myself or any other counterpart he works with and bring them online to be able to do a conference call. We're going to make you look good in front of the business owner. This is something that, this is my 34th year. I started when I was 21 years old in the industry. And, you know, he's got access to the best carriers out there. We're one of them. I've enjoyed the privilege. He's a super individual to work with. And we just want the opportunity to make you look good and to work together.
Thanks for that. Appreciate that. And yeah, I'm just going to echo what you said too. The 5% of all, you know, we run these all the time. I never run them with 5% compound. They are just priced out of the market on every carrier's product. Okay. Well, I have no other questions from anyone. So with that, we did record this. I will get the recording out to those who want it. It may come out to all of you anyway. It depends on what marketing decides that they're going to do with it. We will get you the additional pieces that Richard mentioned earlier, both the client guide and the agent guide to taxation for business entities. We will be taking a break from these for the next couple of months. We'll pick them back up again in January. So be on the lookout for additional ones coming out next year. So with that, Richard, thank you so much for being here. Really appreciate you. Thank you all for being here. Have a great rest of your day.
Thank you, everybody. Have a great day.